You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to the Deep Dive. We are so glad you are joining us today because we're unpacking something that is quietly reshaping your daily life.
Yeah, in a really massive way.
Truly. I mean, if you think about traditional banking,
Yeah.
it has always been built around an architecture designed specifically for humans. you know.
Right.
Historically, that meant grand marble pillars, velvet ropes, and like the heavy wooden desk of the bank manager.
It was essentially theatrical.
Yes.
The entire physical space was designed to make you, the human customer, feel secure, grounded, and frankly, a little bit small in the face of the institution.
And the crazy part is, even when we moved into the digital age, that fundamental dynamic didn't really change.
God.
The architecture just sort of shrank down to fit inside our pockets. We traded the velvet ropes for a sleek mobile app interface, but it was still built for your human eyeballs.
Exactly.
You know, buttons to tap, charts to look at, passwords to remember.
You still had human inputs, human decisions, and, well, a whole lot of human friction.
So much friction.
But we are currently witnessing a massive, profound shift away from that. The financial landscape is being completely rewired, and the target audience isn't necessarily us anymore.
Wait, really?
Yeah, we are transitioning from a financial system built for human users to one built for AI agents.
Okay, let's unpack this. Because if the new financial system is being built for AI, that just changes everything about how money moves.
It changes the entire paradigm.
Right. And to understand how this is happening, we brought a massive stack of fintech newsletters, reports, and launch announcements from late April 2026.
A very heavy stack today.
Yeah, no kidding.
Huh.
Our mission today is to cut through all that information overload and connect the dots on this transition. And it seems like we have to start with the brains of the operation.
Definitely.
The sources point out that banks aren't just using basic machine learning algorithms anymore.
No, the industry has aggressively entered the foundation model era.
The foundation model era.
Right. To understand why this matters for you, look at how things used to work. A bank might have one, isolated machine learning algorithm that just looks for credit card fraud.
Okay.
Then, a completely different algorithm built by a different team handles your credit score by looking at your loan history.
So they were totally disconnected.
Completely. Today, institutions are building massive, domain-specific foundation models that are trained on their entire proprietary ecosystem of data.
Oh, I see. So instead of a bunch of specialized, disconnected calculators, they're building one centralized brain that understands every single interaction you have with your money.
That is the perfect way to look at it. Take Revolut as an example from the sources.
Okay, what are they doing?
They recently replaced their legacy systems with a proprietary model they call Pragma. And the sheer performance leap is staggering.
Oh, like how staggering?
Well, they reported a 65% jump in fraud recall, meaning they catch significantly more bad actors.
Wow.
But even more crucially, they saw a 130% boost in credit scoring performance.
130% boost. That is massive.
Hmm.
But how does an AI model actually do that? Like, why is it so much better than the old credit scoring system?
Because traditional credit scoring just looks at static historical data, like whether you paid your mortgage on time last month.
Right, the usual stuff.
Exactly. But a foundation model looks at thousands of micro behaviors in real time.
Oh, and interesting.
Like, how often do you check your balance? Where do you spend your money on Tuesday afternoons? Do you typically transfer funds right before K-Day?
Wow, it tracks all of that.
Yeah, it builds this highly complex, multi-dimensional picture of your financial reliability that a traditional algorithm simply can't process.
Which I guess explains why Revolut is reportedly eyeing an IPO valuation somewhere between $150 billion and $200 billion.
This is a staggering number.
It is. I mean, they already hit $6 billion in revenue and $1.7 billion in profit back in 2025.
Yeah.
Their proprietary data isn't just a feature. It's an incredibly deep competitive moat.
It really is. But building that moat requires a level of capital and infrastructure that is almost hard to comprehend.
Right.
We're seeing Google commit a massive $40 billion investment to the AI startup Anthropic.
$40 billion.
Yes. And that funding is tied directly to performance milestones and the use of Google's custom TPU chips.
Oh, right. And for those listening who might not spend their weekends reading hardware manuals, TPU stands for Tensor Processing Unit.
Yes, exactly.
Basically, instead of using general-purpose computer chips, Google designed these chips specifically to handle the massive, complex math required to train these giant AI brains.
Right. And every financial institution wants access to that kind of brain power.
Makes sense.
A recent Bain report shows that CFOs globally are boosting their internal AI budgets by 83% over the next 2 years.
Almost double.
Exactly. But there is a very stark divide forming here. There's a huge gap between companies running small experimental AI pilot programs and the ones actually scaling AI into their daily production.
Yeah, the ones in production are practically playing a different sport at this point.
Totally.
Like Customers Bank, which is a mid-sized commercial bank, they just announced a partnership with OpenAI.
Right, and it's a big deal.
It is.
Yeah.
Because they aren't bolting a customer service chatbot onto their website. They are fundamentally redefining their entire commercial banking operations.
Automating the core stuff.
Yeah, automating lending, deposits, complex payments. Which brings a fascinating new term from the sources into the spotlight: agentic commerce.
Agentic commerce, yes. This is the core of the rewiring we mentioned earlier.
Right.
Agentic commerce represents a shift away from UI-driven software, software built with screens, buttons, and drop-down menus for humans toward agent-mediated workflows.
Okay, translation for those of us trying to visualize this: how does an agent actually interact with a bank if it doesn't use a screen?
Well, instead of pointing and clicking, these systems use things like APIs, MCPs, which are model context protocols, and CLIs, or command line interfaces.
Right, a lot of acronyms.
Yeah, but in plain English, the AI sends a direct string of text or code straight to the bank's server saying, execute trade X at price Y, or verify the funds in account Z.
So the machine talks directly to the machine.
Exactly.
Like we used to be diners struggling to read a massive, complicated menu in a foreign language.
I like that analogy.
Right. And now we have a personal AI butler. But the butler isn't reading the menu either. They're just walking straight into the kitchen, skipping the words entirely, and passing digital tickets back and forth with the chef.
The API.
Yes, the APIs. So the transaction happens instantaneously, before you even know you're hungry.
And the entire industry is racing to build out this kitchen.
Oh, I bet.
Visa is expanding its Agentic Ready program into the Asia-Pacific and Latin American markets.
Huge.
Backbase just rolled out an AI-native banking OS specifically to unify those frontline operations for machine interactions. And at Stripe's recent Sessions conference, the focus was overwhelmingly on this AI-driven commerce. The clear consensus is that the future winners in financial software will optimize for agents as their primary users, not humans.
But wait, if future software winners optimize for agents as the primary users, does that mean the human user interface, like the apps we tap on every day, is practically dead?
Well, it changes the economics entirely. Historically, the narrative was that AI would just replace human labor and drive costs down.
Right.
But the sources highlight a new framework for total addressable market, or TAM.
Okay.
The argument is that AI actually expands market sizes entirely. Because it dramatically lowers the cost of executing a task and is available 24 hours a day, the raw volume of transactions just explodes.
So it's not just doing the same stuff cheaper, it's doing way more stuff.
Exactly. That volume is the key. If an AI agent can analyze a market, negotiate a contract, and execute a purchase in 3 seconds, it's going to do that thousands of times a day.
But wait, if these AI agents are making thousands of micro decisions and transactions a minute, traditional banking rails must be a massive bottleneck.
Right, absolutely.
Because a system like SWIFT, which is what banks use for international wires, they can take 3 business days to clear.
Yeah, too slow.
An AI agent operating in milliseconds can't really take the weekend off just because it's a bank holiday.
Right. That is the exact friction point driving the next massive shift. AI agents need infrastructure built specifically for machines.
Okay.
They need a programmable money layer. And that is where stablecoins have hit an absolute inflection point.
So, just for the listener who might be fuzzy on the terminology, a stablecoin is a digital cryptocurrency that is pegged to a stable asset, right?
Yeah.
Usually the US dollar.
Yes, exactly.
It's designed to keep a constant value of $1, avoiding the wild price swings we normally associate with crypto.
And their usage has completely exploded.
Really?
The sources show stablecoins are now handling $33 trillion in annual transaction volume.
Trillion with a T.
Trillion with a T. And there's $300 billion currently in circulation.
Wow.
This is no longer experimental. This is the foundational plumbing of the new internet economy.
That's incredible.
Coinbase, for example, is aggressively positioning itself as the full-stack payments platform for this era. They're combining their developer tools, their USDC stablecoin distribution, and their own blockchain network called Base to power programmable payments that AI agents can use seamlessly.
And this isn't just happening on the fringes of tech either, right? It is penetrating mainstream corporate finance.
Yeah, everywhere.
We see the fintech unicorn ramp rolling out $0 fee-free conversions between standard dollars and USDT, which is the Tether stablecoin.
Right.
And they're letting businesses do this across multiple blockchain networks like Ethereum, Solana, and Plasma.
And the choice of networks there is crucial. While older blockchains were slow, networks like Solana and Plasma process transactions in fractions of a second for fractions of a penny.
So it's practically free.
Exactly. Companies like Tempo are taking advantage of this speed to add enterprise-grade features directly on-chain.
Like what kind of features?
Things like subscription billing, auto pay, and complex accounting reconciliation. They're moving them entirely onto stablecoin rails because it is vastly faster and cheaper than traditional banking.
Even the government is feeling the pressure to speed up here.
Oh, definitely.
FedNow, which is the U.S. government's instant payment rail, they just had to add a new network intelligence API tool.
Right, I saw that.
Yeah, it provides instant security insights before transactions clear, just to manage the sheer velocity of modern
The
finance.
speed is unprecedented.
Here's where it gets really interesting to me, though. You know, for years, crypto was pitched as this volatile revolution. It was a Vegas casino for day traders.
True.
But what you're describing sounds incredibly practical. Is crypto finally becoming, well, boring? Like, instead of being a casino, it's just becoming the underlying plumbing, sort of like email protocols?
When financial infrastructure becomes invisible and, as you said, boring, that is when you know it has achieved true global scale.
Right.
But this introduces a really fascinating contradiction.
Yeah.
While the back-end, the plumbing, is getting hyper-efficient and completely frictionless for AI agents, the actual human experience of managing money right now is falling apart.
It's an absolute disaster. One of the reports in our stack literally runs with the headline, digital banking and fintech have ruined the customer experience.
They make a very compelling argument. Think about your own digital life.
That's exhausting.
Modern finance has devolved into a totally fragmented ecosystem. You are likely juggling 5 or 6 different apps. You're undergoing endless biometric identity checks just to log in. You have the persistent anxiety of irreversible crypto losses if you click the wrong link.
Oh yeah, one wrong click and it's gone.
Right, and trying to figure out how your digital assets will be inherited by your family is a logistical nightmare.
So how are companies actually responding to this friction? I mean, what's the fix?
Through a massive wave of rebundling.
Rebundling.
Yes. Companies are realizing they can't just offer one tiny feature anymore. They're trying to bring everything back under one roof through aggressive vertical integration.
Do you have an example from the sources?
Yeah, take Mercury, for example. They are a platform that caters heavily to startups. They just secured a conditional OCC charter to become a national bank.
Ah, okay. And the OCC is the Office of the Controller of the Currency.
Right.
So for you, the listener, getting this charter is a massive deal.
Yeah.
Because for a long time, cool fintech apps were basically just pretty user interfaces slapped on top of traditional clunky partner banks operating behind the scenes.
Exactly. By getting their own charter, Mercury eliminates the middleman. They own the actual infrastructure.
Wow.
This means they can launch their own lending products, integrate payment rails like Zelle directly, and completely control their own economic destiny rather than sharing revenues with a partner bank.
We see the exact same strategy with Adyen too, right?
Yeah.
The massive payment processor.
Yes, Adyen is a great example.
They just acquired a loyalty platform called Talon, one for 750 million euros.
A huge acquisition.
Yeah. So for you listening, the next time you're checking out online, Adyen isn't just silently processing your credit card. They're using their massive transaction data to embed personalized promotions, discounts, and loyalty rewards directly into your checkout screen in real time.
They're transforming from a simple infrastructure pipe into a unified commerce engine.
But wait a minute. This trend should raise a red flag for anyone who's been following fintech for a while.
You mean the contradiction?
Yeah, I'm getting a bit of whiplash here. Wasn't the entire pitch of FinTech 1.0 that we were going to unbundle the big clunky banks?
That was the promise.
The pitch was, don't use your bank for everything, get a specialized app for trading, a different app for high-yield savings, and another app for splitting bills.
Right.
But now it sounds like they're all just trying to rebundle and become the exact same complex super apps we were trying to escape in the first place.
It absolutely feels like a contradiction. But it's actually the classic business life cycle in tech.
Is it?
Yeah, you unbundle to disrupt a legacy industry, and then you rebundle to achieve scale and actual profitability.
Profitability, of course.
Because the digital real estate on your phone is incredibly crowded. Financial institutions have realized they can no longer win just by offering a slightly better user interface or, a sleek dark mode.
Right, dark mode isn't a business model.
Exactly. To survive, they have to capture consumers in highly specific niches, communities, and life stages before anyone else gets to them.
So what does that look like in practice? How do they capture those niches?
Well, let's look at the generational divide.
Okay.
Gen Z, for instance, has highly fragmented banking relationships. They demand total transparency from their brands.
Makes sense.
But crucially, research shows they still desperately want in-person human guidance when it comes to high-stakes decisions like taking out a mortgage or making a major investment.
So they want an app to buy a coffee, but a human to buy a house.
That's a good way to put it.
That makes sense.
Yeah.
But the strategy for the next generation, down Gen Alpha, is wild to me.
Yeah, Cash App is making an incredibly aggressive move here.
They really are. They're targeting 6 to 12-year-olds with parent-managed debit cards.
6 years old.
Yeah. The parents control the deposits and the allowance, but the child gets the physical card and their own app experience.
It is a calculated race to lock in a lifetime user as early as possible.
Absolutely.
But they aren't just targeting age demographics, they're embedding financial tools directly into the places you already spend your time.
Right, meeting people where they are.
Exactly. We see TikTok partnering with Visa to launch a debit card specifically for UK creators, allowing them to get instant payouts from their live streams rather than waiting for a bank transfer.
And Goldman Sachs just backed a company called Cashable with $60 million.
Cashable is super interesting.
It is, because their model is brilliant. They integrate directly with your employer's payroll system to offer personal loans.
Right.
And by having direct access to your payroll data, they can underwrite the loan with far more accuracy and drastically reduce the risk of you defaulting.
Even your weekend hobbies are becoming financialized.
Oh, yeah.
PayPal just signed a multi-year deal with the NFL. They're embedding Venmo directly into fan behaviors, like splitting the cost of tickets, paying for stadium parking, or buying food in the tailgating lots.
Wow, Venmo for tailgating.
Yeah, the strategy is clear. If you wait for people to actively open your banking app, you've already lost. You have to meet the money exactly where it is moving.
And speaking of where money is moving, the sources highlight a massive pivot away from traditional retail stock trading toward alternative and prediction markets.
Yes, a big shift.
Robinhood recently reported rising profits, but it wasn't from people day trading meme stocks like they did a few years ago.
Yeah, completely different.
Their premium gold subscriptions jumped 32%, and they successfully launched event-based prediction markets, which completely buffered a major drop in their crypto trading volume.
Prediction markets are experiencing an absolute boom right now.
Yeah, what's going on there?
We see platforms like Hyperliquid challenging incumbents like Kalshi and Polymarket. In prediction market, you aren't buying a share of a company. You are buying a contract based on the outcome of a real-world event.
Like what kind of events?
Will inflation hit a certain number? Will a specific policy pass? Hyperliquid is integrating these event-based contracts directly alongside traditional crypto and equity trading in one massive, unified system.
So while the retail market is trading on real-world events, there is an entirely different strategy unfolding at the top end of the wealth spectrum, right?
Yeah.
Massive capital is flowing into what the forces call AI-proof assets.
Yeah, this is a direct reaction to the technological acceleration we've been discussing. Wealthy investors and private equity firms are realizing that software is commoditizing almost everything.
Right.
So where do you park billions of dollars? You buy scarce, human-centric cultural assets that an AI simply cannot replicate.
Oh, like sports teams.
Exactly. Thrive Capital recently bought a stake in the San Francisco Giants baseball team. Clear Lake Capital put in a $3.9 billion bid for the San Diego Padres.
Though it's worth noting that Clear Lake's investors, the people actually providing that capital, they're pushing back hard.
Yeah, there's serious concern over fiduciary duty.
Right. The investors are asking if the leadership is losing focus on their core tech funds just to go play sports owner.
It perfectly highlights the tension of this era. Capital is fleeing toward physical scarcity. But at the same time, access to the companies actually building the AI future is finally being democratized for the rest of us.
Finally.
Naval Ravikant just launched a new SEC-registered fund called USVC. For just a $500 minimum investment, everyday retail investors can get access to top-tier private tech companies like OpenAI and Anthropic.
Wow.
You no longer need to be a millionaire to get through the door.
So what does this all mean for the listener? We've covered so much ground today, from $200 billion AI foundation models to the mechanics of stablecoins, all the way to 6-year-olds tapping debit cards.
It's a lot.
It is a lot. But I have to bring it back to that Cash App strategy for a second. For the listener with kids, what is the real end game there? Is handing a sleek debit card to a first grader actually about building early financial literacy? Or is it just a race to brand indoctrination before they even learn long division?
Well, the industry public relations teams will always argue it's about financial literacy.
Naturally.
But the economic models of these super apps heavily rely on the latter. If we synthesize everything we've looked at today, a very clear picture of the future emerges.
Okay, lay it out for us.
We are moving rapidly into a bifurcated financial era. On the back end, we have invisible, hyper-efficient AI agents executing complex transactions on programmable stablecoin rails.
Right.
On the front end, human-facing finance is becoming hyper-tailored to you. Your financial life is no longer centered in a bank branch. It is embedded in your employer's payroll system, your favorite sports team's app, or your child's digital allowance.
Which means the true competitive advantage for these companies isn't just having the best technology anymore.
No, the technology is becoming the baseline. The real moat is proprietary data and unified ecosystems.
Okay.
Whether you are Revolut training a massive AI model on user behavior, or Adyen embedding targeted loyalty discounts directly into a checkout screen, the ultimate winner is whoever can most seamlessly connect the dots between your human habits and automated execution.
It really brings us back to that image of the grand marble bank we started with.
It does.
You know, the velvet ropes might be gone and the heavy wooden desks have been replaced by APIs and digital tokens, but the architecture of money has never been more complex or pervasive.
Very true.
And it leaves me with a thought that I want you, the listener, to mull over long after you've finished this deep dive.
Yeah.
If our entire financial infrastructure is being fundamentally redesigned so that AI agents can communicate seamlessly, and platforms are learning our spending habits from the time we are 6 years old, at what point does managing your finances cease to be a uniquely human activity?
That is the big question.
10 years from now, will being good with money simply mean that you were smart enough to hire the right AI algorithm to do all the thinking for you?
It just might.
Thank you so much for joining us on this deep dive. Keep questioning the systems around you, and we'll see you next time.
Spoken Tech, for your ears.